Hello and welcome to another episode of the Consumer Credit Matters podcast. I'm your host, William Black. With the major retailers now finished reporting earnings, this felt like a good moment to step back from the headlines and take a deeper look. In this episode, I'm joined by retail analyst Charlie O'Shea to dig into what the numbers are actually telling us about consumer behavior, fulfillment strategy, Target's performance in particular, the role of credit, and what really matters as we head into the holiday season. Charlie O'Shea, welcome back to
Hey, Will.
Consumer Credit Matters podcast. How you doing?
I'm good, Will. Good to see you. How are you?
I'm doing great, thanks. I'm really happy to have you on again. Here we are, lead into the holiday season, of course. Right. And I thought we'd turn to you to kind of separate the signal from the noise on what has been a pretty interesting set of numbers coming out of all the big box retailers.
Yeah, it's it's a continuation of a theme that's been running for a long time, and it kind of got, slowed during COVID, but in some cases magnified during COVID. We've been dealing with a barbell in retail for years, where there's been a bifurcation, and those that had money to invest could invest online, and those benefits are currently, bearing fruit. They could invest in stores, and they could invest in people, and they can invest in price. And I keep referring to this because I think it's topical. Back in 2015, in October, Walmart and this was kind of a seminal event, and I think looking back, people would agree with that. Doug McMillon stood on the stage at the New York Stock Exchange, big conference room. We were all in the room, all the analysts, and he outlined their medium-term plan for spending, and earnings were going to get hit pretty hard. And I watched thumbs flying on cell phones and BlackBerries and everything faster than anything in the world. And the stock price literally dropped 10% within a couple hours.
Mm-hmm.
Everybody rebelled. And I was fortunate enough to go on Squawk the next morning. And I basically said, this is exactly what brick and mortar needs to do. This was in the height of Amazon's going to take over the world. And as you know, I was on the opposite side of that. And those investments paid off, and other retailers followed that program if they had the money. So when you look at the top performing retailers, they're all highly rated companies credit wise. They all have balance sheets. And when you look at the poor performing retailers, they're not highly rated. They don't really have balance sheets, which means they didn't have enough money to invest. And if you're, a retailer that's scrambling to meet their that's got a debt maturity coming up, for instance, and you're worried about even being able to meet that, you're not going to invest online. You're not going to invest in people. Your stores are going to look lousy. Your website's going to be clunky. Your delivery is going to be lame. I mean, you're going to be fighting an uphill battle. And we're still seeing that happening now. You look at the companies that are doing well, the Walmarts, the Best Buys, the Costcos, TJX, BJ's Wholesale, which is a company near and dear to my heart. They had the money. They made the tactical investments necessary, and they're reaping those benefits. I mean, look at what Amazon's been forced to do during that period. Mini fulfillment centers. There was one down the street from me here in Bucks County that I used to literally monitor that thing, and they would run 300 vans a day out of there, which is like 70,000 deliveries a day with that fleet of third-party owned vans. That was their way of combating a brick and mortar network. And they're still doing that.
What you're describing, these structural shifts, these investments, are pivots that were done, as I recall anyway, during the pandemic. I mean, we're talking about several years ago. So they had to have then the foresight to see, as Wayne Gretzky says, where the puck was going in this case.
Right.
And so now it sounds like the retail environment is more difficult. I mean, I hate to say it's more difficult than it was during the pandemic, because it was certainly challenging, maybe in very different ways, but it was very challenging then. But I'll make the argument that it's more difficult today. And some of that is due to this so-called K-shaped economy that we're talking about. Although we know that the vast majority of that consumer spending that I mentioned is coming from the top echelons who are not struggling. But nonetheless, it is a challenging environment. You mentioned the fulfillment centers.
Yeah.
I guess that makes them more efficient. and probably more responsive. What other changes did they take?
Unlocking the stores. Um, I wrote something where I talked about the advantages brick and mortar had with respect to an online business once they unlocked the power of those stores. And you look at a company and, we'll go deeper into Target, but Target, in the high 90% of Target's online orders are handled by the store base. I mean, that's crazy. I mean, it puts so much stress on the stores, but it works. And it worked for Target, even during the pandemic. Now, obviously, there's some issues, but being able to use the stores, Walmart's got almost 6,000 physical locations in the US if you count Sam's. That's a very powerful weapon. The fastest way to get something is to go to the store and buy it.
Well, and the other thing that I find surprising is if you listen to these earnings calls, everyone now is talking about buy online, pick up in store
Oh
as
God.
an
Yep.
important channel. So you kind of get, in a way, you get the best of both worlds. I'm not sure I'm convinced personally because I like to have things delivered right to me, but
Right.
this is a very popular channel for a lot of consumers out there. They have the ability to browse and comparison shop and so on online. That's very convenient. And then they can pick up the
Yes.
good in store. I
Yeah.
don't know if they're saving on shipping or they just want to have touch and feel the whatever it is, garment that they're buying and so on and so forth.
Buy online, pick up in store is a huge weapon for brick and mortar retail because, again, when you want something instantly, instant gratification, you can go on the website, you browse, like you said, and it can be ready in an hour or two. You hop in the car, you go pick it up, you got it same day. You don't have to worry about, as good as Amazon is, 100% of orders are not done when they're supposed to be done. You get the alert, your order's been delayed, so it's going to come tomorrow. Well, what if you needed it today? The only way to do that is to go to a store. And Amazon has spent tens of billions of dollars on its fulfillment, logistics, everything network to avoid building stores. The last thing Amazon wants is a big brick and mortar network. But again, Walmart with that store base, buy online, pick up in store. They'll put it in your trunk. The Target store near me has 22 spaces dedicated to online pickup. Before the pandemic, I think there were like 4. So it takes up a lot of space in the parking lot, but they're active and they're used. And I'm in that store fairly often, and they're loading stuff in trunks all day.
Yeah.
That's powerful, and it maximizes the value of that store asset with a caveat that it can put undue stress on the store and it can create in-stock issues and it creates logistics issues. And that's kind of where, during the pandemic, there were some retailers that were literally, the anecdote drinking out of a fire hose, there were retailers that were drinking out of water cannon because they were essential and others weren't. And they saw huge swings in revenues and in demand and sales and the whole 9 yards. And there's no way you can keep up with those costs. I mean, it takes years to build out a network. Your revenues go up 30% in a year and a half. That's a lot. And if you didn't foresee that, and nobody foresaw the black swan event of COVID, no one was prepared. They were doing stuff on the fly. Best Buy was quasi-essential, but Corey Berry made the decision to shut the stores. They still got 85% of their pre-pandemic sales because they did buy online pickup and they also were shipping online orders. Dick's Sporting Goods was another one that was non-essential, but maintained a lot of its sales because it used its stores effectively. There's a Dick's near me, place an online order, be there in an hour, and they put it in the trunk. It's like, this is perfect. So that's part of the brick and mortar advantage that we see, or that I've seen over the years. And it's finally come to fruition. People that never worried about this stuff before the pandemic started using it and said, hey, this ain't so bad.
And so it's that change in consumer behavior, which is not an easy thing to either adapt to or see coming, has persisted, is what you're saying. And so those investments for the companies that made them are now paying off. You ran through a laundry list of retailers in this earnings season. who have put in, I'll call it respectable, certainly comp sales, same store sales numbers, called in the mid to low single digits,
Mhm.
positive. Um, we'll talk about the exception to that here in a moment, that being Target. But what does that kind of third quarter mid to single digit positive comp store sales tell you about the state of retail? And here again, I'm thinking out loud about, okay,
Mhm.
well, these are challenging times. Inflation is still in the headlines. It's still biting for sure. Um, Tariffs are, you know, taking a toll. I imagine there's a lot of hand wringing around, who's going to eat that cost
Mhm.
ultimately. Is it going to be the consumer? Is it going to be the retailer? Or how much are both going to share this increase in costs, and so on and so forth?
You have heard me rail about comp store sales for years that I'm not a huge fan. I never have been because year over year is tough. You gotta go back several years to really gauge how they are because somebody could have had a horrible quarter. There could have been a macro event, a black swan event, or on the opposite side of it, it could have been, you know, the effects of a hurricane on a home improvement retailer, for instance, where
Mhm.
sales spike. And then you look at last year, say, "Oh, gee, they had a great quarter." Well, they really didn't. You have to look at things in kind of through a different lens. But um, the consumer is on one hand stressed. At the lower end, we know that. I mean, the concern about the SNAP recipients, 40 million Americans are on SNAP, some form of SNAP or WIC assistance, and the catastrophe that was causing during the shutdown, that opens up a lot of eyes. I don't know that anybody knew that, over 10% of the U.S. population was relying on public assistance for food, among other things. I
And
don't
this
know I don't know if that truly resonated with people until then. Um,
and this speaks to the big box retailers because a lot of them also sell groceries, I think, right?
exactly.
Yeah.
Walmart's the largest SNAP, provider in the U.S. And then you have Kroger. You've got Costco, which has a huge food business.
Hmm.
Target's food business is top 5 or 6, depending on how you dimension it. So that would hurt, and it would also hurt store traffic. So you would have the lower end consumer, you know, tr- going to the dollar stores for God's sakes, and trying to just get through that period of going to food banks. I mean, we saw the things on the news of people saying,
Right.
"I've never had to do this before, but now I'm going to a food bank." So that was unduly stressful. That's a late Q3, early Q4 phenomenon that we'll see. I'd love to see how the Q4 part of it
Right.
plays out. So when you overlay that on top of the broader retail environment, okay, if they're not buying food, they're not buying anything else. And if they're worried about where that food's going to come from, how
That's
they're
right.
going to get the money for food, they're not going near a store. I mean, they're going to be home and they're going to be marshaling resources in a big way. Um, Contrast that with the upper end consumer. And, Walmart has steadily, since that meeting in 2015, they have steadily beaten the drum that our consumer demographic, our customer demographic, keeps going up in income. And in that meeting, Doug McMillan said roughly a third of our households are over $100,000 in income. And it was like gasps in the room. And Walmart has appealed to that upper end consumer. The stores are fresher, the merchandise is higher quality. If they bought Vizio, a decent, flat panel TV company, they've consistently tried to up their game in every single product category. I can remember years ago, um, their electronics was awful. Apple wouldn't sell them. Now they've got a full suite of everything. They've got top line television. I mean, it's really gone up.
That to me reflects they're putting their money where their mouth is
Yeah,
around wanting to have a more, say, a broader appeal to a broader swath of
right.
shoppers, and it's perceptible. I mean, you
Yeah.
can see it when you walk into a store now.
Um, so, again, we've got a barbell with retail quality, with the quality of the retailer, and we've got a barbell with the consumer, where you've got the upper end consumer, as you said earlier, is fairly well insulated from any of these issues. And the lower end consumer has been getting hammered for the confluence of factors. I mean, I just saw recently the consumer confidence score hit a quote unquote record low. I don't know if there's a lot of noise there driven by some of the media portrayals of how the economy's doing and whatnot. But these are meaningful data points.
So what I hear you saying, Charlie, is the comp store sales might be sending a false signal. Well, maybe that's not true, but don't read too heavily into them, because there's a lot of noise when you start to do comparisons. And you mentioned a few of them, and not only inflation, and thankfully the inflation has come down dramatically, but that makes all the more, your point all the more salient. That is, don't compare this quarter with a year ago, because the inflation environment alone. You're also, I think, saying another thing, and that is that there might be some of the meaning of what's happening in the country at large being lost in these headline numbers, where you still have large cohorts of consumers, households who are struggling, and maybe even struggling more. But that's not being picked up in some of these numbers, because you are attracting the higher income cohorts into these big box retailers like you haven't before as well. And they are sustaining some of this spending activity that we're seeing show up in the stores. So, and we could probably go on. There's a whole host of reasons why these comps aren't good. I think you made a really good point there. I do want to change topics, though, or not change topic, but go into one of the areas of focus in this season's kind of round of earnings calls, and that was Target. They have certainly been the focus as a standout in a bad way, in negative comp store sales relative to some of the others that you mentioned. And so let's drill down on that a little bit. I think I've seen you quoted in some of the news shows that you've been on that they are being unfairly depicted or portrayed by many retail analysts. And let's go into that a little bit.
Okay. Pre-pandemic, Target was humming along, $75 billion plus minus in revenue, steady margins, great credit, A2 Prime 1 when I had them at Moody's. Bumps in the road historically, but on balance had done well. When you and I first met back in 02, 03, they were having problems with their Target Visa rollout. They dropped the ball completely in Canada, and this is all prior regime type stuff. On top of that, they had the credit card breach around the holiday season that year, and just got killed. Let the CEO go, brought Brian Cornell in. He came in, cleaned house like you do, bit the bullet, almost $6 billion in losses up there, and the shareholders bore all of that. And then embarked on this, multi-year growth strategy. And it was successful. And then the pandemic hits. And if you look at the sales from Target, pre-pandemic to post-pandemic, they're up almost $30 billion. Sales per square foot are up $100 in round numbers since pre-pandemic. The store base has not moved. They've built more distribution. So you are literally trying to, push a watermelon through a garden hose. And there are going to be issues. You're not going to have, in-stocks could be hit. You can't assume those sales are going to stay. I mean, think about it. It's hard to grow $30 billion of revenue in a year and a half off a $75 billion base. I don't think I've ever seen it before. But Target's problem, and it's an opportunity now, and I'm glad that the company is, recognized it by saying we're going to jack up the CapEx, which they absolutely have to do. They have to invest now. But what if you make the investments, assuming that $100 billion in revenue is going to be sustained, and it's not? I mean, it's kind of a false analogy or false analysis to say, well, they should keep all those sales. TJX reopens. Okay, TJX's revenues, I had a chart somewhere, but I'm not going to bore anybody with it. There was an easy $25 billion worth of sales that were given up during COVID, and then those companies reopened, and they got their sales back. But it didn't come from Target. Where did it come from? Because Target's revenues haven't fallen. I've heard all this stuff about, the whole LGBTQ plus stuff that they did with the merchandise and the whole DEI effort. and the contributions to BLM, and I'm not going to get political here, but all that stuff that became, that was noise and became, cannon fodder for certain media types, um, hasn't had a sales impact. Maybe those sales, they've proven to be sticky because they've held on. So now you make the investments and be able to maintain those sales, drive your margins back up, and build some more stores. Their store base was static for years.
I think what I hear you saying is they can't and shouldn't try to be all things to all all customers. They have a. I mean, look, all of these companies that we're talking about have a distinct brand. Target has a very distinct brand. In terms of their merchandise forward kind of approach to retailing. And I want to come back to, made a comment on DEI because this has been in the news for sure. There's been a bit of a backlash, and Target again has been, rightly or wrongly, the focus of that, probably as a consequence of the fact that they do, merchandise their products differently. It's very front of store, in your face a little bit more than other retailers choose to sell their merchandise, and that helps them when you have a wind to your back around DEI efforts. But that pendulum, as we know, is swinging in a different direction now, and I think they caught some of that backlash. I don't really have fingers on the pulse to know whether that is still playing out, or if that is. It certainly doesn't seem to be as hot a topic as it was, but has it now played out? Is that no longer showing up in the numbers, or is that even really in the numbers at all? I don't know what kind of granularity you have around those types of dynamics.
There's been all this literally noise about DEI and some of the merchandising they did. It doesn't play out in the numbers. It just doesn't. People are saying, oh, their comps are down 2%. They got nowhere to go but down based on where they are now. Sales have nowhere to go but down based on this physical footprint. They cannot maintain $107 billion with what they have today. And people should realize that. Target's revenues spiked during COVID, like every other retailer, and never came back, never came down. They've maintained that revenue base. And now the challenge is to manage to that sales level because it looks like it's sustainable. Okay, so now you build the infrastructure out to profitably manage that sales growth. Whereas, up till now, they haven't been able to do that because they haven't been certain that they were going to maintain that sales level. Now they've shown over the last couple of years that those sales aren't going away.
So just for listeners who might not be as familiar as you are, we have a situation at Target now where there's going to be a changing of the guards. The current CEO, Brian Cornell, is stepping down, retiring, I think early next year sometime.
Yeah, February.
Michael, is it Fidelki?
Yes.
Michael Fidelki is the current CFO, and he's stepping in.
He was CFO, was promoted to COO and president a couple of years ago as part of the grooming process.
Right. And so he's inheriting what you've described as he's inheriting a strong sales and momentum also behind those sales. And so the challenge for him, if you had his ear for a day, what are the top three things say you would expect him to focus on?
Build more stores.
Okay.
Or acquire more stores. Okay. There's a lot of real estate out there.
Yep.
Start picking off some sites. Look at where your online sales are coming from. Put brick and mortar in those locations in some fashion. They've already expanded the distribution capability by like 30 to 40%. Do some more of that based on how you handle the store growth. You're using your back rooms for a lot of online fulfillment. And there's been a lot of whining in the market about why are they bringing up an insider? How many people out there can run a $100 billion retailer? Not many. It's tough. It's not as easy as these pundits seem to think it is. You need experience with that retailer.
In short, you're your prescription really is this is not major surgery that they need
Mm-mm.
at
No.
all. You said more stores and improve logistics, and some of that will come naturally. Well, not naturally, but some of it can certainly be leveraged and be the byproduct, as I mentioned,
Mhm.
synergistic byproduct
Yep.
of building out more stores and fulfillment capabilities. But this is not major surgery for a company of this size, or the direction that they're already traveling in, right?
No. This is blocking and tackling, and it's blocking and tackling with the recognition that we are attractive enough to the consumer that they have not left. I've seen some reports out there that Amazon should buy Target. Please. I mean, let's get real. Amazon hasn't unlocked Whole Foods. That still remains a struggle. It's hard to run a brick and mortar retailer. It's a lot harder to stock stores than it is to put stuff on a UPS truck from a warehouse and ship it out and basically cede your last mile capability to somebody whose paycheck you don't sign.
Got it.
I mean,
Okay.
it's hard, and food is difficult. There's an Amazon Fresh store up the street from me here. It's really cool, but it's really tiny. It's not competitive with too many of the other supermarkets. If you're a Prime member, you get 5% off, and
Give them
that's nice
time.
to see.
Give them
Yeah,
time.
exactly. Well, I've heard that for a long time.
Okay.
I've heard and I was on the other side of the Amazon's going to take over the world theory. Now we have Walmart's online business over $100 billion in the
Mhm.
U.S. That's pretty scary. But I mean, I keep going back to, oh, Amazon should buy Target. Well, I'll give you a little history lesson here for the listeners. Back in 1987, they passed the toughest anti-takeover legislation, I think, in the country, where if somebody acquires 20% of the stock of a Minnesota domicile company, they have to go to the board for permission to buy any more. So in order for anybody to acquire Target, they have to get board approval. I don't see that happening. I just don't.
That's a great technical point. That's a
No.
great technical point. So
Yeah, there's
that's a
there's
huge
no
hurdle. Yeah.
yeah, there's no way Target gets acquired unless it wants to be acquired. And I don't see the board saying, "Gee, let's sell ourselves now. We're Staples. We're going to try to sell ourselves. We're going to try to do this. We're going to try to do that."
So let's zoom out a little bit from Target. I want to
Mhm.
come back to one other kind of dimension of retailing. I mentioned the importance of consumer spending to the economy, of course. 2/3 of our economy is built on consumer spending. A lot of that's done on credit. I like to say nobody spends money they don't have quite like Americans. A lot of the sales in all of these big box chains comes on a credit card, either a store card, a
Mhm.
proprietary card, or a co-branded card. How is that intersecting with the current retail dynamic? Is it as important as ever? Is it growing in importance? That type of thing.
I think it's always been critically important. I mean, you and I have covered this for a long time. It's
Hmm.
always been critically important. You and I covered the Sears sale,
Hmm.
years ago. They wanted to keep the servicing because many of them had it intertwined with their customer service capability, and they didn't want to give that up. And they wanted some control over point of sale, especially Sears because of appliances.
Well,
And home
Sears, they used the quip from Sears was, they were a credit card company that happened to sell stuff. I
exactly.
mean,
I remember that.
that's
Oh
how
no,
big the credit
yeah,
program. And as I recall, the profitability from their store card versus the retail side of their business was about 50/50.
it was.
And
It
from one
was.
year to the next, it kind of flipped on that 50/50 divide.
Yeah. Um, yeah. Credit's still incredibly important, and you've got interest rates for some credit cards, into the 30s now, which is pretty scary when you really think about it. Um, the lower end consumer relies heavily on credit. But
I'm
one thing I want to touch on,
Yeah, please.
student loans,
Hmm.
the impact of student loan payments on retail. We've been dealing with moratoriums, the impact that can and will have on retail as these payments start up again is going to be pretty significant. We're talking about what, 1.6 trillion in round
That's
numbers
correct.
of balances. I think that's a shoe that's going to drop.
Hmm.
in the not so distant future.
You raise a very good point, and this has certainly been talked about and written about quite a bit. The moratorium is off by over a year now.
Yeah,
Actually, it's off by over a couple of years, but they started reporting back to the credit bureau. So you have credit consequences to your credit
exactly.
profile starting about a year ago now. You can see in the New York Fed's data that delinquencies now that they're reporting have spiked up to far higher even than they were
Yeah.
pre-pandemic or even, GFC kind of era. So it's definitely, and that was all predictable and to be expected as you have a slug of borrowers who were never going to pay, who were always going to be delinquent, now being reported in one big slug. We'll see where this normalizes. My assumption is it will normalize somewhere where its old run rate used to be. We'll see, but which is, by the way, quite high, right? In the scheme of consumer credit. But this has been talked about, that the stalling, delaying of household formation. We could have a podcast just on that topic.
Yeah.
I did not pick up on that thread in the earnings calls. I don't know if maybe I missed it, but I don't think that the retailers are pointing that as at least having much of an impact this time around at this point in time.
It's, as you said, it will normalize over time, but normalizing can bring up a whole different kettle of fish here. What's going to happen and who's going to get hurt and who's not.
Right. Yeah. I mean, like I said, that's a, this is a philosophical question. It is a social construct question in my mind that could warrant many podcast series.
Yeah.
In fact, let's move on. I want to kind of now take the conversation from third quarter earnings. I think we've covered that pretty well, and now put on our, look into our crystal balls, and we are now what, I don't know what the official start of the holiday shopping season is anymore.
Labor Day.
We're in the old school was Thanksgiving. So yeah. What are you seeing in terms of the health of the consumer and the retail sector as we enter into this very important time of the year? Is it going to be a strong sales season?
I have always thought that the consumer, that we will have Christmas, okay, and Hanukkah. let's be frank, so the season starts ever earlier. I think the things to look for have always been the things to look for. How deep are the discounts, and what happens on Tuesday after Thanksgiving? What are the stores doing? Are they cutting deeper? In which case they had a lousy weekend. Are they standing pat? Which means things probably went okay. But when you see a store that was 40% off this week and next Tuesday is 50% off, something went wrong. So that's something I always like to be in the malls the Tuesday after Thanksgiving, not Monday, but Tuesday. Monday, people are still, recovering.
It's Cyber Monday. That's an important day.
Exactly.
Too, right?
And that's exactly right. Before Cyber Monday, it was, sleep it off Monday. So those are important things to think about. The consumer's got money. The overall consumer has money. I know consumer confidence is down. That's, to me, skewed toward the lower end because of the math. Again, there's more households earning less than 30,000 than over 100. So any poll you take, any survey you do is going to skew negative. It has to, just because of the math. I think you're gonna see a healthy holiday. You're going to see a promotional holiday. It's already started. Black Friday sale started last week. I always viewed the holiday season as ending. Super Bowl Sunday was my last day for the holiday, because the last 2 weeks, the 2 weeks leading up to the Super Bowl are the largest TV selling period.
Right.
We all know that. So I think the elongation of the holiday season makes it tougher to dimension year over year. You heard me rail about how I hate comps, and I hate comps because of that as well. The 6-week period doesn't matter as much as it did before.
It's a shorter season this year too, isn't it?
Thanksgiving is later this year by a couple of days, but that doesn't matter. When you start looking at when does it really start, the quote unquote season, that's really fool's gold for an analyst. It really is. You've got to look at the whole fourth quarter. especially now. Amazon does a Prime Day. People compete with Prime Day. They do this, they do that. Sales get pulled forward for all these events. It's the entire fourth quarter that matters. And you don't know about that until April
Right.
when people report, their fourth quarter sales, with quarter ends in January. You'll find out in early March, late February, early March, how well the fourth quarter went. And you'll get sales numbers. We'll get the MasterCard data, which is actually pretty good. You'll get the year over year stuff. That's okay. But how'd your margins hold up? How promotional did you have to be? What happened after Christmas? Okay, you heard me talk about the Tuesday after Thanksgiving. What about the week after Christmas? You get a
Right.
ton of gift card
Returns.
activity.
Mm-hmm.
Yeah, returns and clearance promotions in the month of January to get stuff off the books before the end of the fiscal year.
I mean,
So that's why the season lasts a lot longer.
that
But I think it's going to be a good year.
that makes sense. I think this dynamic of sales continuing to be generated, but at what? But who's paying the price for the?
Right.
For is it going to be tighter margins or a higher price? It does look like the consumer. You mentioned the consumer surveys earlier are pretty negative. Certainly around inflation expectations. And affordability is the new, I don't even want to call it the new buzzword, but it's certainly
Yeah.
gaining more circulation lately. Um, and in inflation in general, it seems to be percolating up into the mainstream again. Um, and so that is going to be probably a top of mind issue as we enter the holiday season for consumers. Retailers can react to that by sacrificing margins. You mentioned discounts and promotions. And how does that net out? We're going to find out, I guess, in January or February when fourth quarter earnings come out. But it's going to be tough, I think, to predict that. But you're on the record for saying you think it's going to be a very good holiday season in both respects, sales and margins.
I think so. I mean, I think there's a lot of positives happening for the consumer in general. The lower end is the lower end.
Mm-hmm.
But I think the people that typically spend for the holiday are going to spend, and they're going to drive the sales levels. The upper end consumer is going to spend. It's going to mask, I think, some of the issues at the lower end, like it kind of has been. But I think overall, it will be a healthy holiday. As far as sales versus margins, all sales are not equal. I was always an operating income driven analyst. I still am. I don't care what your sales are if you don't make money.
Right.
You can, you sell $1 for 99 cents. That's not going to help anybody. You need to be vigilant around margin. You need to be vigilant around something that I call promotional cadence, which is how you stack your promotions during the year. Retail is a long game. It's not a short-term game. I was asked a question by an investor the other day. What do you think about, Trump has floated the idea of semi-annual reporting. I said, I have hated quarterly reporting since I got into this industry over 30 years ago. It forces management to have rabbit ears about the street if they're public and manage for the short term. And in an industry like retail, what we've seen over the last 25 or 30 years with the onslaught and online, if you try to manage for the short term, you're dead long term. You will not survive because there's somebody bigger and better than you with more money that will outspend you over the long term and has the discipline, like Walmart did, like Target did 10 years ago, to take the short-term bullets from the investors and say, you know what, this is the right thing to do. You guys don't know what you're talking about. This is how we're going to run our business. And it turned out to have been successful.
You're making a great, I think, counterpoint to the concern of moving to a less frequent reporting cycle. And Exhibit A, everyone says, oh, short-term thinking. But the fact of the matter is the track record shows, as we've just talked about during this podcast, is that the good retailers are long-term, medium to long-term focused, regardless of how frequently they have to report.
Exactly.
And therefore moving from a quarterly to a semi-annual or whatever the frequency is shouldn't move the needle for the retailers in this example, who want to survive and thrive.
Exactly. I mean,
Yeah.
invest or die.
Right.
That was kind of the mantra. And it was, I used to use the term retail Darwinism. It's survival of the fittest, and it's survival of the strongest and richest. The strong got stronger in retail, was born out during the pandemic. Certainly. I mean, those retailers that had made the investments could afford to do the things they needed to do. There's all sorts of examples like that out there right now.
Charlie, awesome conversation as always. I knew this would be, very educational. I love to have these kind of stretched out conversations around a topic that better than anyone, frankly.
Thank you.
And no, it's been really great. And I'm going to be looking at this fourth quarter, earnings next cycle of earnings calls. I think with a lot more perspective than I had before, and I hope our listeners also share that perspective now, with the benefit of this conversation. So thank you very much for
Thank
joining
you, Will. Great
Consumer
doing this
Credit
as
Matters
always.
again. It's been a pleasure, walking through this with you. And listeners, thank you very much for tuning in. We'll see you next time. Thank
Thanks,
you.
Will.